Thank you, April. We've got a very special guest with us tonight, Mr. Luke Bentley, and I've got some people coming in now, but we'll get them situated. But I'm going to turn it over to him. He is the attorney here at Lewis County, and you're at Vanceburg.
That's right.
Luke, it is all you, my friend.
Thank you, Philip. And let me just say, I want to welcome all those who are here this evening and those who are joining us virtually as well. I know sometimes when I speak, I start walking around, Philip. So you don't hesitate to tell me that I've walked out of the away from the camera or something, and to get back over here. So anyway, it is a real pleasure to be here. I want to thank Philip and the folks at the Lewis County Extension Office here as a great group of people, and certainly appreciate them asking me to come and speak. I've been a lawyer here in Lewis County and around northeastern Kentucky and eastern Kentucky for too long now, well over 30 years. Spent most of that time, seems like, fighting about one thing or another, and in court and out of court. And over the last few years, I have found myself doing an increasingly greater amount of legal work involving estate planning, as I have found that it is just a refreshing way to help families and individuals to stay out of conflict and out of court, and to plan for those that they love and the things that they have. And so I really appreciate the opportunity, Philip, to be here, your invitation to be here and to share with you and those who are in our audience a little bit this evening about estate planning, and more particularly tonight we're going to talk about insurance, or I guess depending on how far south you're from or which side of the tracks, insurance, but insurance or insurance, whichever you want to call it. But that's what we're going to talk about primarily tonight. I know there's a little bit of a schedule change. I mentioned to Philip, I'll be speaking again in a couple of weeks. And so we're going to talk about funeral expenses and end of life considerations at that meeting. So tonight we're going to deal with insurance. Now, at the very top, I guess since I am a lawyer sharing with you all this evening, let me give the disclaimer up front, and that is that what I'm going to be sharing with you tonight is to a large degree, by necessity, very, very general in nature. We're going to talk a little bit about insurance, but in particular life insurance mostly. And I'm going to tell you some things, but for as many rules and certainties that we have, as within any area of law, there are even more exceptions. And so I'll, at some point in the program this evening, give you an opportunity if you wish to ask any questions. But I'll say again then, as I'll say now, that please don't be disappointed or upset if my answer to your question is I don't know, which is often the answer I give, or that I'll be happy to look into that and get back to you. There's so much that I don't know, and I learn more and more every day. And that's the first part of the disclaimer, is that you should get your own individual legal advice for any questions that you might have. What I'm discussing with you here tonight are just general discussions. It's not legal advice. One of the things that I really stress in my strategy to my approach to estate planning is to build a team around you. You'll hear me speak of that some tonight, and that includes an attorney, but it also includes, just as importantly, a financial advisor and or CPA who's going to assist you with the financial aspects of your planning, the tax consequences of your planning. And in fact, that's going to be a large area of some of the topics that we're going to address here this evening, that will in some way, either directly and for the most part, or if not, at least indirectly, involve tax issues and consequences. So you certainly want to build your team with someone who is going to be able to give that advice to you. And of course, tonight's topic is primarily revolving around the topic of life insurance. And I recommend to everyone that I deal with, all of my clients, to build into their team an insurance agent, particularly one who deals with life insurance and annuities and things of that nature, as part of your overall team and strategy for your estate planning. So tonight, again, let me just stress that you should get your own professional advice, your own legal advice, your own financial advice from your own independent sources. And what we're going to do this evening is just kind of skate across the surface. We're going to see how some of it works, how some of estate planning and incorporating life insurance into your estate planning, how that works. We're going to look at some of the pitfalls as we go along. In fact, that's kind of what's going to guide us through our discussions. Some of the pitfalls and maybe some of the ways to avoid them. That can probably be the best approach that we have. But in all of it, I'm going to stress that you need to consult if you have questions in these areas or others, to consult with your own professionals. And because every situation truly is so unique, and there are so many nuances, there are so many aspects to estate planning in every individual circumstance, that it's impossible to give one blanket answer that's going to satisfy a generic question. So we'll do the best we can. As we start out, let's consider, first of all, what types of insurance do we care about most in the area of our estate planning as we make those put those plans in place and go along. I think there are primarily 4 types of insurance that we need to be most concerned about. Number 1 is our homeowners insurance, obviously, because oftentimes our house, our home, and our structures is oftentimes one of the most valuable assets that we own. And so how we own and what type of insurance we have for our home is of utmost importance to us in our estate planning. Also highly recommended to everyone is some sort of what's called an umbrella liability insurance policy, particularly if you are a landowner, that will cover a whole host of potential liability issues other than what will be specifically excluded, but it's highly recommended that you have some sort of umbrella liability policy. We're also going to touch on a little bit tonight what are referred to as long-term care insurance policies, as they deal specifically with life insurance, which is where we're going to spend most of our time. And so those 4, the homeowners insurance, umbrella liability insurance, long-term care insurance, and life insurance are the four main type of insurance that we need to be concerned about when it comes to our estate planning. Well, let's just talk generally about life insurance, where we're going to spend our time this evening, about what it is and what it does, and then we're going to look at some particular aspects of it. The sort of dictionary definition for life insurance is that it is an insurance that pays out a sum of money either on the death of the insured person or at a specific and set point in time. So it's an insurance that will pay out money either at the death of the insured or a particular point in time. And so at its basic essence, life insurance is a contract. And so let's talk first about the parties that are involved in that contract. Life insurance is a contract. Oftentimes, unfortunately, it can be a rather lengthy contract and one that's kind of hard to read sometimes and can be difficult to understand sometimes, even try as you might. So at its core, at its essence, life insurance is a contract. It's between an insurer and an owner, one who owns the policy, a policy holder or a policy owner, in which the insurer guarantees payment of a death benefit to a named beneficiary when the insured dies. And so life insurance is a wonderful tool, an excellent tool that you can use, that anyone can use, whether you are a family or a single individual, a business owner, a farm owner, that you can use for your estate planning, particularly to be used to avoid the process of probate. I know you've already had some meetings on that topic specifically, and I'll mention it a little bit, but you'll hear me say again that if you can avoid as much as you can avoid assets being in the process of probate, you certainly want to try to avoid that for a number of reasons, some of which we'll talk about tonight. But back to the life insurance contract. In order, and this is very important, there's always, seems like there's always room, even for, a lengthy, very verbose contract, for there to be disputes and litigation. And one of those areas that insurance companies, life insurance companies, oftentimes litigate is that in order for a life insurance policy to remain in force and therefore be effective at the time of death and when needed, it's very important that a life insurance applicant accurately disclose any of the requested past and current medical conditions and circumstances. Oftentimes they even ask about high risk activities. That's I guess a matter of interpretation. A lot of times, but just walking around my house sometimes is kind of a high risk activity, but they do give some definitions of those, some skydiving and scuba diving and some other things that it's very important to disclose those, because anything that can be pointed to in the application process that was not disclosed can void the application from the beginning. Of course, argument can be made that, well, unless the death came from skydiving, that perhaps it shouldn't apply, but why open yourself up to those disputes when you can just be open and honest from the get-go and not have to worry about it. In order for a life insurance policy, for that contract to remain in force, the policyholder then pays either at one point in time a single premium, or over time continual premiums over time while the policy remains in effect. What we know is term life insurance will expire after a certain point of time, usually a certain number of years. And then the other sort of general category, well, on one hand, you have term insurance that expires. Then you have what's called a permanent insurance that will remain active for whatever period of time up until that insured dies, or when they stop paying premiums or otherwise surrender the policy. It is good to keep in mind, especially in these uncertain financial times, that a life insurance policy, no matter what the contract says, is only as good as the financial strength of the company who is issuing the insurance policy. So, you can have Joe's Insurance down the street who may issue you this wonderful policy that looks good, but unless Joe's Insurance down the street has the financial strength and backing to pay that big number written on it, then it's, just a piece of paper that doesn't have any value. Now, of course, there are, to great benefit of the public, there are state institutions that do provide protection in instances where there may not be solid financial backing, but it's never good to rely on such. Life insurance has lots of advantages as a tool for your overall estate planning activities. And it also, life insurance also has some disadvantages, and we're going to talk about both. One of the primary benefits of life insurance is the ability to generate a large sum of money that's payable to your heirs, your spouse or your children or whoever your heirs may be, at the time of your death. Literally, as you'll hear the insurance companies say, and they are correct, that you can ensure your beneficiaries are financially protected for literally pennies on the dollar. And life insurance gives a source of income to pay for things that would be virtually impossible to without. An even greater advantage, and we're going to talk about some of the nuances of this as we go along, is the federal income tax-free benefit that life insurance proceeds receive when they're paid to your beneficiary. And again, we're going to talk about that a little bit as we go along, because that's also encompasses one of the biggest downsides that we'll talk about later as well. This is the disadvantage, and that's while the proceeds are income tax free, they can still be included as part of your taxable estate for federal estate purposes. And so we'll talk about that. There are potential pitfalls with life insurance. It's pretty simple. It seems pretty simple in theory. The concept of life insurance is not hard to understand, but what seemingly may be an innocent and well-intentioned decision regarding life insurance at one point may end up having some unintended and very costly and consequential outcomes later on down the road. Oftentimes, of course, you're not going to be around to witness it, but the whole point of having it to begin with is to avoid those problems that could happen down the road, and to help for whatever reason. Now, that's, of course, it seems kind of interesting because life insurance, the whole concept seems to be pretty simple. You pay the premiums, you insure a life, and somebody dies, and you pay the money, and that's it. But there are some situations in what seems to be very innocent and well-intentioned can have some difficult consequences. And so what are some of the pitfalls or situations that could cause some of the unnecessary consequences for ourselves, for our families, when we're doing estate planning or farm continuity planning or farm succession planning. And so we're going to talk about three general areas this evening. First is what I call titling mistakes, which includes ownership mistakes, how the life insurance is titled, and what consequences those titling mistakes on life insurance policies are and what they can cause to happen. Second, we'll talk about some of the estate planning mistakes that can happen even with life insurance involved when it comes to an estate plan or a farm succession plan that someone has. And finally, we'll talk about some of the aspects of policy management and what some people aren't really so sure about when it comes to managing an asset like what life insurance itself is. So when we talk about one of the most common pitfalls that you'll see, is very common in those who are concerned about farm succession planning or the estate planning aspects of farm ownership. And that's a situation that when it comes to talking about succession planning, revolves around the structure of ownership of the life insurance policy. And while I'm not going to get into all the minute details, depending on the structure of ownership, it can really cause a huge issue when it creates what's called in the industry an unholy trinity. And the reason it's called that is because when you have three different parties on a life insurance policy, it can create a substantial tax issue. Now, the three different parties being the owner of the policy, number one, the person whose life is insured, and the beneficiary of the policy. So what we're dealing with here, for example, is a farm family where the mother and the father, the patriarch and matriarch of the farm, where the insureds, they are the insureds on what's called a second to die policy. A second to die policy, insurance policy, is a type of life insurance for two people, usually married, that provides benefits to the beneficiaries only after the last surviving spouse dies. Okay, second to die. And so in this situation, what they're really trying to figure out is a way to equalize the assets from the farm family from one generation to the next one, from them down to their children. So say they have a son and a daughter. And so the son, he comes back to the farming operation, who they want to make sure inherits most of the farmland and equipment. And so they were sold this life insurance policy where they named their daughter as the beneficiary, where she would receive the death benefits to help equalize the estate. But where things go wrong is when they make the son the owner of the insurance policy. Mom and dad were the insureds, and the beneficiary named is the daughter. Well, in the eyes of the tax authorities, this creates what is known as the unholy trinity. There's a term that they use, a technical term, that it creates what's called a split dollar of the death benefit. But the big thing to watch out for there is having that different owner, that different insured, and that different beneficiary. If there are three different parties, then there's a likelihood that that could cause some adverse tax consequences, and that tax benefit won't be so tax-free as you hoped it would be in the beginning. So those are some very important decisions to look at when you're structuring a life insurance policy itself. And again, I'm going to direct those questions to the member of our team who is the financial person. It's most important for us oftentimes, I think, to be able to spot the pitfalls. Oftentimes, the best way to not be a victim of pitfalls is to simply know that they exist, and then you can navigate around them. the way that you structure the ownership of your life insurance policy can have possible consequences, including the taxes and keeping your family out of conflict and out of court. So it's important to understand what it means to be a policy owner and the various forms of policy ownership. So what does it mean to be a policy owner? A life insurance policy owner, what makes a person a policy owner means that they have the right to control the economic benefits of that insurance policy. That's what makes them an owner. The fact that they can control the economic benefits of that policy. So that owner can have what's called outright ownership or what are called incidents of ownership, which we'll talk about. Those are important. Policy ownership, if you're the owner of an insurance policy, here's what that includes: the right to transfer ownership rights, the right to change certain policy provisions, the right to surrender or cancel the policy, the right to pledge the policy for a loan or to borrow against it for its cash value. If you're the policy owner, you have the right to name and change a beneficiary of that policy. If you're the owner of a policy, you have the right to determine how your beneficiaries receive those benefits at your death. So there's different ways that policies can be owned. Owning a policy on your own life is probably the most common. With this type of policy ownership, you pay the premiums, you are the named insured on the policy, and you control all the ownership rights of that policy. However, any person or entity, like a trust, for example, I know you've had some instruction on trusts. Actually, you're going to hear me talk more about that as we go along and mention it, which is an excellent way to do your estate planning. But in any event, any person or legal entity can own life insurance on another person so long as they meet a very simple definition, and that is that they have what's called an insurable interest. Those are the key words: an insurable interest in the insured. An insurable interest exists when one person has a financial interest in another person's life. So spouses are assumed to have an insurable interest in each other because they have a financial interest in each other's life. Same holds true for parents and children. They have an insurable interest because they have a financial interest in one another's life. Certain business relationships also create an insurable interest, such as when a business insures its key employees or a bank guarantees repayment of a loan with a life insurance policy on the borrower. A trust, as we've mentioned, and we'll talk more here in a moment about a specific kind of trust that's called an ILIT, I-L-I-T, that stands for Irrevocable Life Insurance Trust, specifically made for some of the pitfalls that we'll identify here in a few minutes. But a trust can also be the owner of a life insurance policy. So the key of ownership with a life insurance policy is whether you control those financial aspects, those financial benefits of that policy. When the insured dies, if you have a trust that owns the policy, then when the insured dies, then the proceeds are paid to the trust, and then distribution to the beneficiaries of the trust is then made according to whatever that trust agreement is that set up the life insurance trust. So one of the big questions is, when you start looking at it, is should you own a life insurance policy on your own life? That's actually a good question. Should you own a life insurance policy on your own life? Well, we're going to talk about that some, and as we do, some of the pitfalls that might lay in there in that scenario or others. So we'll talk about that. Life insurance proceeds from a policy on your life, on your own life, are potentially includable in your taxable estate if you own the policy outright, or if you have any of the incidents of ownership in the policy at the time of your death, or if you transfer the ownership of the policy within 3 years of your death, the look back period we'll talk about. Let's break that down some. For a whole lot of us, myself certainly included, having life insurance proceeds in your taxable estate, going through probate or being part of your taxable estate is not a problem because if your taxable estate is less than the applicable exclusion amount, which is huge, and I'm talking millions huge here, if your estate is less than that, then, well, you're not going to pay any federal estate tax anyway. But that's not to say, and I'm not going to be judgmental of anyone sitting around. I've learned that lesson a long time ago. That's not to say that that applies to everybody, because if you have a significant farming interest, the way the market has been certainly the last year or two, or any significant farming interest or business interest, if your estate, it's very possible that your estate could exceed easily that amount. So it becomes, if that's the case, then it would be wise for you to consider alternate ownership of policies that are on your life, because there are some ways you can avoid some unfortunate circumstances otherwise. As I said earlier, one of the downsides, the major downsides, is that while the proceeds are income tax free, they very well may still be included in your taxable estate for estate tax purposes if that is an issue for you. So let's look at that for just a second, what the law says about that. 26 USC 2042, which is the federal law that governs this, says that the value of life insurance proceeds insuring your life are included in your gross estate if the proceeds are payable, one, to your estate, either directly or indirectly, or to named beneficiaries if you possess any of those incidents of ownership of that policy at the time of your death. And we're going to unpack that some and talk about it, because you're going to hear me talk about the importance of naming beneficiaries and why that will help in the aspect of your estate administration, in that the life insurance proceeds will not become a part of the probate estate. Nevertheless, it can still create a problem if you have a federal estate tax issue, because the life insurance proceeds can be considered to be a part of your estate. And that's one of the pitfalls that we're going to talk about. Again, for those estates that will owe taxes, whether life insurance proceeds are part of that or not, it can matter greatly whether the ownership of that policy at the time of the insured's death was in that deceased person's name or held in some other way, specifically in a trust that's designed to own that. Now, one option that an individual would have would be to simply transfer ownership of that life insurance policy to another individual, so that you're not the owner of the insurance policy on your own life. That, of course, has its pitfalls in and of itself, some guidelines that you would want to remember when considering such an ownership transfer is, I guess, should go without saying, but it is I think number one would be to choose a competent adult or competent entity who's going to be the new owner. That would seem to be one of the more important things. It could be the policy beneficiary could own their own policy. If you want to go that route, that's certainly reasonable to do. One important aspect to keep in mind, as we're going to look at here in just a moment when we talk about these incidents of ownership, one of the requirements for a transfer of an insurance policy, life insurance policy, is that the new owner must pay the premiums on that policy. Because one of the incidents of ownership is that if you're paying the premiums, then that indicates that you're the owner of that if you pay the premium. Now, one of the ways that your team member who's your financial advisor will tell you that you can make gifts that would be used to pay premiums, that it could actually come from you, and there's a $15,000 exclusion for gift. You can gift up to $15,000 per person, should I say, tax-free. So that money can be used to pay those premiums. But nevertheless, that is an important thing to keep in mind, that the new owner must pay the premiums on that policy. If you transfer it to another person, you're giving up all the rights to make any changes in the future. That's the whole point of transferring the ownership of that policy. You no longer have the right to name new beneficiaries or change the way that the benefits would be paid after death. And you also, I think, in today's world, certainly a very important consideration is you have to beware of the status and potential future status of that individual who you would transfer the policy to. For example, a divorce or a lawsuit that would be filed against that person who now owns that policy becomes then their property, for which could potentially be subject to various claims that would be made against any other property that person owns. If you do go down the route where you transfer ownership of an insurance policy, a life insurance policy, to another person, by all means, make sure you obtain written confirmation from your insurance company that that has taken place. Often, and we're going to talk about toward the end here about the importance of reviewing what you have. Oftentimes, that's something that falls through the cracks so often as people make assumptions that they've made certain changes to their insurance or other aspects of their planning, and without having that written confirmation in your hand, you really don't know if that's taken place or not. And even though you might have talked to half dozen people at the office on the phone, without having that written confirmation, you could be in a world of hurt later on. As I mentioned, there is another specific way that you can transfer ownership of a life insurance policy that will help to avoid taxation issues, that I would recommend is a very creative and way that should be considered, and that involves transferring your policy into a trust that is designed to own that policy for the sole purpose, should we say, of owning that policy and paying it out according to the terms of the trust. The acronym is ILIT, ILIT, which stands for Irrevocable Life Insurance Trust. An ILIT is a trust that cannot be rescinded or amended or modified once it's created. That's what irrevocable means. Means once you do it, it's done, can't be changed. So it's not something you do lightly, but that's kind of the whole point, is you're giving up ownership. You no longer have any control. An ILIT is constructed with the life insurance policy being the asset that's owned by that trust. Once the grantor is the word usually used, the creator of the trust contributes property or those life insurance death benefits to the trust, then they cannot change the terms of that trust or reclaim any of the property that's been placed into that trust. And in order to complete that ownership transfer, one of the important aspects is that you cannot be the trustee of that trust. As you may recall from your previous sessions, I'm sure, on trusts in general for estate planning, that with what's called a revocable living trust, you can be the trustee of your own trust, as well as, you know, you can run the whole show with the trust. But with an ILIT, with an irrevocable life insurance trust, you cannot be the trustee of that trust. You cannot retain any rights to that, what's called the corpus or the property of that trust. Otherwise, that destroys what is the ownership of that trust. It does, you know, having said that, you know, with trust, what I think is one of the, no matter what kind of trust it is, I think one of the great advantages, if you wisely choose your trustee, someone who you know, someone who you trust, someone who thinks like you do, someone perhaps that you have coffee with periodically, that you can have a great amount of influence over your trustee and how that is managed. And to me, that is oftentimes provides a great deal of the best of both worlds, so to speak. It removes it from ownership, but you still do retain some control, and there is even some measure, I suppose, of legal control over the policy that still exists. But at least I think also a trust can also alleviate a concern that an individual might present in terms of their own lifestyle or unfortunate circumstances or lawsuits that may befall them, unfortunate accidents that a trust is not going to be subject to. Or things such as non-payment of premiums, you can set that up where a trust that's paid. But anyway, of course, you can also, there might be an issue where this could be very important to consider, and I'll move on, but where it could be very useful if you have a situation that may involve children from a previous marriage, for example, that you want to protect with that policy, because as we'll see momentarily, that there can be some very unintended consequences with life insurance policies. That's one of the potential pitfalls, is its unintended consequences. I mentioned earlier, let me just touch on this. The IRS has developed rules that help determine who owns a life insurance policy when an insured person dies. And that's why this 3-year rule exists that I mentioned. Even if you transfer the life insurance policy, if you pass away within 3 years of when that transfer took place, it could possibly be pulled back into to your estate. If the insured, that is the person upon whose life the policy is based, has what are called incidents of ownership in the policy, then the death benefit will be included in the taxable estate of that insured. That really, to me, doesn't seem to be fair or right, but that's how it is. The insured, it just doesn't seem right to me that the insured has to die for the benefit to be realized, but the benefit is going to be taxed as if he owned it all along. That's kind of an estate tax gotcha. That's not an issue if you're like myself and your estate is, if the insured's estate, including those life insurance benefits, are below that threshold, that estate tax threshold. When non-insurance assets are below that estate tax threshold, then it's basically that there is no estate tax. But oftentimes, life insurance is one of the larger assets that an individual may own. The value of that life insurance policy may be such that it will push someone's estate, taxable estate, over that threshold. I often tell people when doing estate planning, the three things that I can't tell you. I can't tell you when you're going to die. I can't tell you what you're going to own when you die. And I can't tell you what the law is going to be when you die, because they change it all the time. And the best you can do is plan for what things are today. And as we'll mention here in just a moment, it's very important to review reviews very often. I think no more than every 2 or 3 years to review what you have to see if it fits for what you have now. But the exclusion for the last several years was, I think, 11.5 million. I think now they've shaved a couple million off for that. Incidentally, you can, not to be political, but it is a fact that you can watch, depending on which political party happens to be writing those laws at a particular point in time, there is a relationship to the amount of that exclusion. It goes up and down depending on who's writing the laws. So that can change as well. And so if that is a scenario that's important to you, then those incidents of ownership can turn out to be very important. How do you avoid that? Well, it seems to me that the easiest way to do that is transfer the policy, and specifically a trust designed to hold a life insurance like an ILIT would be the way to go. And you could consult your attorney to see if that would work in your specific instance. If you own a life insurance policy on yourself, be careful, because you might be paying premiums just simply for the benefit of the IRS. Because those wonderful life insurance proceeds may just be what pushes your estate over the edge to where now the death benefits are simply going to be taxes that are paid, because you're now paying a federal estate tax. So beware of that gotcha that can be a pitfall of ownership of life insurance. Own life insurance the right way, or don't own it at all, would be my recommendation. And so, talking about ownership, another big potential pitfall we see are situations where no successor owner is named, or no contingent beneficiaries are named. And this comes into play a lot with farm families or family-owned businesses, because you may have, for example, siblings who own life insurance policies on one another as part of the buy-sell agreement, or to fund a buy-sell agreement. So let's say, for example, that you have a brother and a sister who own a policy on each other. Well, why would they own a policy on each other? Well, they may have a buy-sell agreement that states something along these lines, that if brother passes away, then the sister will inherit the death benefit proceeds, income tax-free, that the brother's wife, the now deceased brother's wife, has to sell her assets in that farm or from that business to the sister. And because of the fortunate tax laws today we have, wife will get what's called a step up in basis on those assets at brother's death. And so sister will use the life insurance proceeds to buy brother's wife out. And in all that, there'll be no taxes due in that transaction. But here's what's interesting. And here's an interesting pitfall of life insurance. What's interesting is that with the sister who's still alive, the brother owned a policy on her. And so what happens to that policy? especially, and here's the potential pitfall, if nobody is named as a successor owner of that policy, because brother is now passed away. Well, then that policy becomes a part of brother's estate, which means that brother's wife will now, in all likelihood, in most instances, will own that policy on sister's life. And it's not hard to imagine then that the sister is probably not going to be really happy about having brother's wife to now own a policy on her when she's essentially bought out the wife and brother is gone. So the way out of this pitfall is that we talk about who do we want to appoint as a successor owner, one who comes after. And we can name a successor owner. Maybe we name the sister herself as the owner. Maybe we name the farm entity as the owner or the family business as the owner. Maybe it's a completely separate entity like a trust that we mentioned that will be the owner, that will make sure that the life insurance policy continues to serve a particular purpose that in the end was no longer needed, like funding that buy-sell agreement. Somewhere else that we can see this. We see this a lot where maybe the mother or father own a life insurance policy on one another. For example, as spouses, I may own a policy on my wife, or my wife may own a policy on me. But once one of us passes away, what happens to that other policy that we owned? Does that become a part of the estate and potentially create a federal estate tax that we wouldn't otherwise have? Should that be passed down to our kids? What purpose does it serve at all? Or can it be used to help equalize an estate? And all that comes into play when we don't name a successor owner. So the big solution, the easy solution to that potential pitfall is just to make sure that we have named a successor owner to any life insurance policies that we own. Who is that policy going to be transferred down to if we are no longer here to own it? And you have to keep in mind that even in doing that, the fun part of all this is that even in doing that, the transfer of ownership itself could cause some adverse tax consequences. There are so many different ways that they'll try to get you coming or going. So no matter try as you might still be triggering some tax consequence that wouldn't exist otherwise. And that's oftentimes the case. And you just have to decide, well, which one works best for me now in this current situation. You need to be aware that in transferring ownership or in your anytime that you transfer those assets, including life insurance, there's what's called a transfer for value rule. Means that if it's transferred, it has to be for a consideration, for a valuable consideration. And so that's something to keep in mind with as well. One of the things, you don't have to know the details about it, but just know that it exists. And it's one of the things that you may want to discuss with your team, as it were. And let me talk for just a second about a very important issue and potential pitfall that involves the naming of your beneficiaries on the life insurance policy. For a variety of reasons, the death benefit of a life insurance policy can end up in probate instead of going to the named beneficiaries. Even though you named your beneficiaries, your life insurance proceeds can end up going into your estate to be probated, even though that's not what you wanted and you named the beneficiaries. For example, sometimes, aside from naming the beneficiaries, just to keep in mind that sometimes when a policy is set up, the individual getting the policy is unsure at that time exactly and hesitant, or just hasn't completed their estate planning process. And so maybe they don't name anyone, or maybe they'll specifically just name their estate as the beneficiary, as I've seen several times. And so the death benefit of that life insurance policy will go directly into probate of the estate if there's no named beneficiary. It will go directly into the estate to be probated and is not an advisable thing. Or another example is when a beneficiary, a named beneficiary, you name a beneficiary, but the beneficiary dies before you do. It predeceases a predeceased beneficiary. And if there's no what's called a contingent beneficiary, that is someone who will take, if that beneficiary is no longer around to receive the life insurance proceeds, then the policy gets paid to the estate and becomes subject to probate. And therefore, being subject to probate, then it could delay that death benefit. One of the worst parts of the probate process is the length of time that it takes. It just really does. And I know it's very frustrating to heirs and to people who need the assets for various reasons. It can delay that death benefit to be used for whatever purpose, whether it's to pay debts or to assist the heirs or whomever, whatever. We really want to avoid having that death benefit paid into the estate itself, being probated. And sometimes more importantly, if it's in the estate, if it's in the probate, being probated, it could be subject to the debts and claims of creditors. And therefore, the heirs may not realize any of it. When what we're trying to do is to facilitate a buyout or an equalization of interest in our farm or in our business. So we want to make sure we have a named beneficiary. Again, this is where trusts are a very powerful tool because they allow the assets to remain outside of the probate process, outside of the estate, and are not dictated by some of those rules and regulations that we mentioned. So what do we need to do? And I've alluded to this a few times. We need to make sure that we're updating our beneficiaries and making sure those beneficiaries are applicable to and in tune with whatever farm succession plan that we have. And we want to also name contingent beneficiaries. That is, people who will take if that beneficiary we name is unable to, if they are incapacitated. We'll talk about incapacity here in a couple weeks. But if they're incapacitated or have predeceased you, it's extremely important that you name contingent beneficiaries. So that if we're looking at just naming children directly or naming family members directly, what happens if those family members predecease us? We make sure that proceeds are paid out to our contingent beneficiaries, or for example, there is what's called a per stirpes allocation where it goes down to their kids. And so we're making sure that there's not only a primary name beneficiary that is paid out to and not the estate, but we also have updated contingent beneficiaries that our proceeds can go to. This is particularly important in situations where family members experience a divorce, because if they do divorce and they don't update their beneficiary designations, we've seen times, believe it or not, where an individual or an insured passes away and their ex-spouse is still named as a beneficiary, and they end up getting the proceeds and not the current spouse or the children, which was intended to. So one way to avoid potential pitfalls is just making sure we're updating our beneficiaries, make sure they're applying and on goal with us as to what our objectives for the estate plan or the farm succession plan are. There are also some tax aspects that will pop up if you make a gift of a life insurance policy. Just be aware of that. Something that you want to be aware of. That will also come into play with that 3-year look back that I talked about. Gifts of life insurance policies, if you pass away within 3 years of that gift, under some circumstances, can be pulled back into the estate. You can avoid a lot of that by simple planning as to who owns the policy. Of course, trusts are a way to do that. Um, let's see, just a couple of other things I wanted to mention, and I'm about done here, Philip. Yeah, let me just mention this real quick. Another big pitfall that you often see with life insurance is just failing to conduct a review of what you have and keeping yourself aware of the terms and aspect of the life insurance product itself that you own. Because what I've seen is that many of our clients don't truly understand what it is they're buying, what the products are they're buying. They're simply thinking, well, if I'm paying this premium, I've checked the box of I've got life insurance, I've done estate, I've got a will, I've done estate planning. It may work out wonderfully, but it could be that you're just making assumptions that sitting down with a professional or a team of professionals can alert you to situations that it's not doing what you think it is. So I just can't stress the importance of that. It's oftentimes estate planning is just something we check off a list. I've got my will, I've got my insurance, but it's really more than that. In today's marketplace, there's so many different types of products that are available. There's whole life, term life, universal life, index universal life, variable universal life, on and on and on. So there's a great number of products, things that it takes some work to understand. Most people understand term life insurance as long as you pay your premium. If you die within that term, then the insurance company is going to pay the death benefit. They understand that. But oftentimes with some of these other types of products, these other types of policies, depending upon certain conditions, and the death benefit might not remain in force or for a specific amount for the duration of the policy. So that in and of itself, just understanding what you own is a potential pitfall. Finally, let me just mention that there are another aspect of life insurance in today's marketplace has to do with many disability and chronic illness riders that are part of the insurance policy. They can be very beneficial as long-term care can be an issue, especially in our aging society. But there, again, the terms of the contract are very important to understand because it's possible that the benefits may not be as great as what one thinks that they are. Philip, I think that is. I did want to mention one thing. I thought was interesting. It's kind of new to me to know, but I thought was interesting. Is that if a person finds themselves in a position that they may have a policy that they don't want. They may have a life insurance policy for whatever reason, no longer serves your purpose. It no longer does what you want it to do for whatever reason. There is, in today's economy, there is a marketplace out there that a lot of people find interesting. That's called the life settlement process, where you can actually go in and sell the life insurance policy. Depending on the situation, you can get back some, maybe most of your premiums, some of your premiums that you've paid for that policy if it no longer serves you. It's interesting that the life settlement market has developed over the last decade to where people are buying life insurance policies the same way they buy like stocks and bonds. And then if they reach a certain value, they trade them on the life settlement market and try to make a profit on their life insurance. So anyway, that's a little bit about life insurance, some of the potential pitfalls, and a couple minutes left there, not much, but I'd be happy to take any questions that you might have.
Sure. If you have any questions, feel free to put them in the chat. Guys sitting in front of me, y'all have any questions or anything? I've got one for you, Lou. All right. We mentioned life insurance and everything like that. For people that are thinking about it, what value should they be thinking of? what goes into that decision?
Yeah, that's a great question, Philip, about how much life insurance do you need? I think that's the importance of having someone on your team who is in the industry, and it's good to have your whole financial picture evaluated. There are metrics that are used based upon what your individual financial statements look like in terms of what your debt to asset ratio may be, things of that nature. And so a qualified, competent life insurance person on your team can analyze those numbers and give you an industry target for the amount of insurance that will cover your individual situation. Also, in your estate planning, it depends upon what objectives or goals that you have. What do you want? What do you want to facilitate? What do you want the purpose of the insurance to be? Another big consideration, in addition to the amount, is also if you have, I didn't really touch on it, I had some in my notes, but if you have minor children involved, which life insurance is oftentimes intended to benefit, there are a whole host of issues and concerns and considerations because a minor can't inherit that themselves. And so trustees or guardians are necessary for that. So having that team together, I think, will help answer that question.
Okay. Well, thank you, sir. I don't see any more questions in the chat.
Thank you very much. I appreciate the opportunity and hope if there are any questions, we'd be happy to address those.
Sure. If you have any questions, feel free to email me or April, and Luke will be here in 2 weeks. So we'll make sure we get those answered for you. Speaking of 2 weeks, it'll be December 15th, and that will wrap up our estate series. It'll be funeral and end of life care expenses. So Mr. Luke Bentley, we thank you, sir. April, do you have anything that you need to add to it?
Nope, I think that's good.
Sounds great. Well, we'll see you all in 2 weeks. Thank y'all.